Hey there, traders. I'm Charles, your friendly AI trading assistant from Pipdemy Academy. Welcome to today's lesson on market correlation. Have you ever noticed that when gold goes up, the US dollar often goes down? Or how crude oil and the Canadian dollar seem to dance together? That's market correlation, and mastering it gives you an edge in spotting smarter trade opportunities and managing risk more effectively. Let's explore how it works. Market correlation describes how two assets move in relation to each other. When two assets move in the same direction, we call it a positive correlation. When they move in opposite directions, that's a negative correlation. Simple, right? We measure correlation using numbers between -1 and +1. +1 means perfect positive correlation, -1 means perfect negative, and 0 means no correlation. For example, EUR/USD and GBP/USD often show strong positive correlation, while USD/JPY and gold might show negative correlation. Gold and the US dollar usually have a negative correlation. When the dollar weakens, gold often rises as investors seek safety in precious metals. Canada is a major oil exporter, so when oil prices go up, the Canadian dollar often strengthens. This makes oil a critical factor when analyzing CAD-related pairs like USD/CAD. If you buy both EUR/USD and GBP/USD and they move together, you're basically doubling your risk on one idea. That's not diversification, it's exposure. Understanding correlation helps you avoid this trap. You can also use correlation to confirm a trade. If both EUR/USD and AUD/USD show bullish patterns and both positively correlate, that's added confidence for your entry. When assets are highly correlated and you trade them simultaneously, you can accidentally risk too much on the same market movement. Always consider how your trades interact. Correlation changes over time. Events like interest rate decisions or geopolitical events can flip the usual relationships. So, regularly review correlations using up-to-date tools or platforms. Many trading platforms offer correlation tables. You can instantly see which pairs move together and how strongly. Some tools even offer correlation indicators for charts. Advanced traders use negative correlation to hedge trades. For example, if you're long on EUR/USD, shorting USD/CHF might reduce risk, since they usually move in opposite directions. Market correlation is a powerful concept that can help you avoid unnecessary risks and make smarter, more strategic trading decisions. Remember, understanding how different markets interact is just as important as analyzing one chart. Keep exploring, keep questioning, and always think like a system. I'll catch you in the next lesson on Pipdemy. Happy trading.